Here is a quote from William O'Neill. Another way to determine the direction of the general market is to focus on how the leading stocks are performing. If the stocks that have been leading the bull market start to break down, that is a major sign that the market has topped. The leading stocks that O'Neill mentions are commonly referred to as the generals. So who are the generals? Well, the generals leading the market higher over the last couple of years go by the acronym FANG, F-A-A-N-G. FANG is composed of Facebook, Amazon, Apple, Netflix, and Google. To understand the outsized effect they have on the S&P 500, consider the following. Per Bloomberg, the 5 FANG stocks currently account for 13.5% of the weighting of the S&P 500. The combined market cap of the FANGs is equal to that of the smallest 252 S&P 500 constituents. On average, each FANG stock has over 13 times the effect on the S&P 500 index than the average stock in the index. So, on the heels of recent weakness in some of today's generals, let's examine whether these stocks are sending us a signal to seek shelter, or if their lower prices are temporary and a rally call for the troops. So let's take a look. Let's start out here with Netflix. And Netflix has fallen 7% since a lackluster earnings report on July 23rd of this year. While earnings beat estimates, they only added 670,000 U.S. subscribers in the second quarter, missing projections of 1,200,000. That was the first time in 5 years they fell short of their user projections. Given that Netflix is trading at valuations that portend significant user growth, any signs that they are approaching product saturation should be especially concerning. Despite the loss, Netflix is still up nearly 200% since January 2017 and over about 85% this year. Amazon released its quarterly earnings on July 26th. The stock closed the following day up about 0.5%, but since then has given back those gains and more. While the market initially seemed to focus on a massive beat in earnings versus projections, investors seem to gravitate to the company's missed revenue expectations and guidance lower for the next quarter. Given that a large chunk of the bottom line earnings rise was attributed to a sub 3% tax rate, it is likely concerns over forward guidance are justified. For the year to date, Amazon is up almost 60%, trading near its all-time high and showing few signs of weakness. But of note is that hiring at Amazon has not increased substantially from the prior year. And another note, Jeff Bezos, his net worth increased to over $150 billion. I'd like a piece of that. Like Amazon, Google smashed its earnings expectations and the stock rose nearly 5% on the day following the announcement. Unlike Amazon, their sales also beat expectations and they did not lower forward earnings guidance. Google is up about 20% year to date and has perched near its all-time highs. Google appears to be the strongest of the generals. Apple's second quarter earnings per share and sales surpassed Wall Street expectations, and they raised revenue guidance for earnings for the next quarter. The only wrinkle was iPhone sales, which account for more than half of the revenue, came up slightly short of expectations. Regardless, Apple is within a few points of its all-time high and may become the first trillion-dollar company. Facebook fell over 20% on July 26, erasing almost $120 billion in market capitalization. The decline was the largest one-day loss of market value in one stock in the history of the U.S. equity markets. Interestingly, the two runners-up are Intel and Microsoft, both occurring in the year 2000. At the time, they were five-star generals that ultimately led their troops over a cliff. Largely responsible for the drop was Facebook's second quarter earnings announcement, which reported weaker than expected revenue and daily activity users, as well as corporate guidance, lowering these metrics in the third and fourth quarters. The stock was also downgraded by a few Wall Street analysts. While the decline was severe, Facebook is still flat for this year and up over 50% since January 2017. Some of the generals are flashing signs of weakness. That said, 2 weeks and 1/4 of earnings do not make a trend. Despite large price losses for two of the generals, the S&P 500 took these drops and earnings announcements in stride. For the week of July 23rd through the 27th, in which all but one of the FANGs released earnings, the S&P 500 was still up 0.61%. Currently, we're focused on the price action of Facebook and Netflix. Given the buy the dip reflexivity that has pervaded the market and these stocks in particular, their price action in the weeks ahead will be telling. If they remain at current levels or drift lower, this is a signal that all is not well. On the other hand, if the FANG stocks that are struggling start to recoup their losses and resume their leading roles, and the market heads higher, we'll just have to wait on the wisdom of William O'Neill. So for today, that's ChewDog Charts. Thank you.